Welcome to the STR Data Lab.
Hello and welcome to the latest edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined again by my long-term guest and coworker, Bram Gallagher. Bram, welcome back to the show.
Good afternoon, Jamie. Always a pleasure.
So, Bram, you serve as our Director of Economics and Forecasting at AirDNA. You are sort of in charge of the crystal balls that sort of provide us our outlook for the sector. And we're going to dive into that a bit today. But first off, how you been? How's forecasting been going?
Well, you know what? Forecasting has been going great. We had predicted about a year ago that this year, 2024, was going to be a year where supply and demand balanced out, and it actually happened. So, very happy about that. And as far as the economics front goes, we've had an election. We've got new policies in the works, which should affect economic variables and should direct some of the forecasting that we've been producing lately. So, it's been an interesting time.
Yeah. So when we recorded around this time last year, there was broadly a sense that we maybe weren't going to go into recession and that we were hopefully going to be able to have a soft landing for the economy in general in the US. How would you describe the economy that we've seen over the past year?
It's resurgent, I would say, if anything. You're right. 2023, it was definitely a down year. We had very slow GDP growth. We had inflation that was sky high, recessionary worries. But 2024, we saw a lot of improvements. So GDP was much higher than we even expected. Incomes have continued to rise, and importantly, that inflation metric has gone down very, very quickly. It's pretty amazing. I've been hearing about this kind of soft landing since I was a very young economics student going to UGA. And the professors had always coached those terms by saying that they've never been able to pull it off before. Every single time they either went too hard and crashed the economy or they didn't go hard enough and inflation came back. But it looks like right now we're on a much more even keel than I expected even a year ago.
So if you were grading the Fed right now, would you give them an A for sort of orchestrating this, or do you think this was sort of other factors at hand and it would have happened no matter what the Fed did?
Well, I think there are a lot of factors at play, but one thing I think that the Fed did really well was how quickly they raised rates. In this modern economy, with all the information technology that we've got and the advancements that we've seen, even in the hospitality sector, means that the economy just reacts to news more quickly. It reacts to shifts and changes more quickly. So I do think that very, very quick increase to the rates was necessary and useful. And kudos to Jerome Powell and the whole gang for anticipating that.
Yeah. And I've heard sort of what's been described as sort of a very robust, maybe one of the best ever economies that we have right now. And with employment growth and very robust, inflation and obviously has come down, maybe not quite at target, but essentially at target. We've got the stock market at all-time highs. We've got the housing market at all-time highs. If anything, it feels like maybe it's a bit frothy and there's maybe additional risk out there of a correction. How do you feel about, one, the underlying sort of key metrics of the economy, and then two, do you feel like we're maybe at extra risk or elevated risk at all of a market correction, given how everyone seems to think that things are great and that their asset prices seem to be pretty, I'll describe it as well priced?
Yeah, I mean, I think there might be some risks in some areas with asset prices. The fundamentals, as you say, we've got a lot of employment. We have wages now increasing in excess of inflation, which is always a good sign. And also importantly too, we could look this last year. We saw big productivity increases. which is very positive because we can stimulate the economy and we can sort of juice it up with interest rates or fiscal spending, but productivity in the end is really what's going to determine wages and income, which will eventually determine what consumers are able to buy. So that productivity is going to that those increases are going to continue the deflation, and that's going to really help keep hiring up and keep the employment growth strong. We have seen, however, there are some issues. There are some really big price increases to housing and housing affordability. And if there's one thing that I've seen this last year is people have been really asking a ton of questions about housing affordability. How are we going to be able to go forward with housing just as expensive as it is? Well, there's some demographics things as well. So we've got a lot more retirees entering their golden years. We've got maybe a labor force that is shrinking. Immigration is way down, or I should say it's on the way down. If Trump's policies are to believe, and so population, and again another source of working able-bodied folks right there is going to be clamped down at a time when we may need it. So there are some risks, but on the other hand, as to your point, there's a lot of positives as well in this economy.
So maybe let's and take that sort of narrative that we see in the overall economy and start applying it to what we're seeing in short-term rentals. And I want to maybe try going about it in two ways. One, and the first, like, let's put our investor hat on and think about, as a short-term rental investor today, how am I feeling about the state of the market? And then two, as a short-term rental operator today, how I feel about the state of the market and the outlook for 2025 and 2026. How does that sound?
Perfect.
All right, so let's start with the investor, as I said, and start with maybe a quick outline of what are the factors that investors, and we sort of hear investors talk most about, and what are the outlook for those sort of key metrics going forward?
Right, sure. So, this is some of the stuff that we have been talking about earlier, some of the pillars of investment as you described them in some of our, conversations that we had. One of those is going to be interest rates, the other is going to be asset prices, because the combination of those is going to give you that return on investment that you're going to be really looking for. So, what we have seen, of course, with the Fed increasing those interest rates rapidly over the last few years, is that the interest rate environment has been generally a headwind. And it's probably going to continue that way. In fact, we have revised our expectations for interest rates. They're going to probably be higher for longer. And the reason for that is that those rates were initially increased to control inflation. And the current policy that is being discussed includes some fiscal stimulus. And that includes, say, tax breaks, but also, some additional spending for border security, et cetera. But that usually has a stimulative effect on the economy, somewhat inflationary. So I think to counterbalance that, the Fed is going to be a little more hesitant about reducing interest rates. Also, if we have severe tariffs or very, very high tariffs, that might exert a little bit of inflationary pressure as well. So both of those things combined, I think, are going to make the Fed more cautious about taking that down. We had initially expected that interest rates were going to decline slowly, certainly more slowly than they increased. But whereas just a few months back, we were expecting, say, the mortgage rates to be under, 6%, maybe 5.5% by the end of 2026. Now they're going to probably be above 6%. So that sort of number, that magic 6% number, don't think we're going to get below that in the near term future. So that's one element of that. And if we're looking for the short-term rental investor in particular, they're going to be very focused on residential housing prices as well. And this is another expectation that economists had with these high interest rates that, often what happens is we had this big run up on housing prices in the immediate aftermath of the pandemic, partially spurred by the fact that we had very low interest rates, and also partially spurred by the fact that, basically that was the only real estate type out there that seemed viable, right? Retail was not, it was all shut down for the pandemic. We didn't know if that was going to be able to come back. Office Similarly, it was completely vacated. We have a lot of fun industrial stuff, but where else is the investment going to turn? Well, residential. So we did see a really big uptick in residential prices. A lot of us expected that we jack interest rates up at an unprecedented level, and we really increased that sky high. We thought there was going to be a housing market crash. It's going to be very, very low prices, but we haven't seen that. We never saw prices go negative. Maybe briefly they held still on a inflation adjusted basis briefly, but really hardly any pause at all. And we're expecting that housing prices are going to be continuing to increase. They might be a little bit slower in 2025, but they're going to be creeping back up to that more 5% kind of long run appreciation that we've seen in the past. Some of that might be the fact that we just haven't had a lot of transactions. So if you've got those golden handcuffs, as many people do, you've got that really low interest rate now in your home. You might not want to sell your house for a discount, knowing that you're definitely going to have a higher interest rate on the next home that you purchase. So that might just be preventing this market from moving anyway, one direction or the other. So essentially, we're in a holding pattern. Prices haven't diminished. Interest rates remain high. So those things combined are going to be something of a headwind for investment. It's going to be difficult. You're not going to be able to do like in 21 and just throw some money at it and expect an excellent return. You'll have to be really careful about and really choosy about where you put your short-term rentals to make the most of your investment.
Okay. So what I'm hearing is that more than likely on the asset sort of home value side, it's sort of more of the same. There might be some pockets of increases, decreases here and there, but in general, the values that we're at today are more than likely only going up. In that, for those that have been waiting for interest rates to come down, we're probably going to be waiting for maybe a bit longer. So, in your crystal ball, or the crystal ball that we use of Oxford Economics for their interest rate forecast, they do not foresee interest rates coming down below 6% out in and over the next 2 years.
That's right. And that is specifically the 30-year mortgage rate for housing society mortgages that the Oxford is predicting. So, there are mortgage rates that are above and below that, but, the movement is going to be very, very slow downward.
Right. So when I'm looking at the sort of, and we're recording this on December 2nd, I typically look at Mortgage Daily or Mortgage News Daily, their sort of real time index. And we're sitting here at roughly 6.9% today. And that looks like it's historically and roughly matched the index that sort of Oxford forecasts as well. So yeah, it's unfortunately going to be a bit in that sort of brief sort of touch back in September of getting close to 6%. Was maybe a, how would you describe it, like a tease of I'm what
Right.
of what potentially could come, but that the sort of higher inflation for longer is going to sort of hold interest rates higher? Or what is this sort of driving dynamic of, and we've got the Fed lowering the short-term rates, the overnight rate that the Fed can control, but the long end of the curve, the and 30-year fixed rate interest rates, the 10-year treasury, are continuing or have expanded and pretty substantially since September.
Yeah, and there was something that happened between the September and today that resolved a lot of uncertainty. So that election, that was well, I wouldn't say a surprise, but I will say that it was a nail biter either side. We really weren't sure, and uncertainty is something that really can throw markets for a loop. And I will say too that I've painted a pretty bleak picture for the investor, but there is one silver lining in that. What I'm expecting for the next few years is that compared to the roller coaster that we've had in the post-pandemic era, we should see at least some more stability, a little bit more predictability about what is going to happen in the economy. But certainly one of the changes that we saw recently was the Trump election and the fiscal plans that Trump has. We know that he's very down on taxes. Trump does not enjoy taxes. He likes cutting them, and that's going to have that stimulatory effect. And that inflation is certainly something that the Fed has been watching. it's ticked back up a little bit in the most recent CPI report. So I think that caution is going to be the watchword. Now that they've achieved sort of the success that they have, the Fed is going to try to hold on to that, make sure inflation doesn't come back, which we know is a problem with inflation that we've encountered in the past.
And maybe let me describe what I've heard the scenarios sort of explained to me and then see if that holds. So, as we think about 2025, if this sort of deviates from the scenario, we can maybe know what to expect in terms of increases or decreases in the 30-year fixed rate mortgages. And that this sort of increase in spending and you mentioned in the outlook that investors are expecting really centers around the Republican Party holding sort of all three branches of government. Like clearly, Trump won the presidency, but if it wasn't in combination with winning the presidency and the Senate and the House, then we wouldn't necessarily have seen this sort of change in inflation expectation happening because with control of all three sides, that people are expecting legislation to actually get enacted, and whether that's spending or tax cuts, which could be stimulus, or additional spending bills that would also potentially be stimulating to the economy. And then thirdly, that the market really isn't yet baking in any massive reductions in spending, maybe related to Elon Musk's Doge unit, the Department of Government Efficiency, or anything like that, because anything that group maybe suggests still has to go through Congress and get approved. And Congress, at least in recent years, has been reluctant to do any massive spending cuts that would necessitate sort of and pulling back on inflation expectations there. Is that the right way to think about it?
I think that's a big part of it. There has been sort of that new office, but it's really unclear what kind of powers, if any, that's going to have besides advisory. And one other element too that I would be remiss if I didn't mention too is that the economy is actually doing pretty well and a little bit better than we expected just from say 6 months ago. There was some upward revisions to GDP. So we're talking about stimulus that is happening in an economy where it's actually humming along pretty well. So that in and of itself, I think is going to give the Fed some pause.
Okay, so given this sort of investment environment, how does that play into your forecast for supply growth in 2025 and 2026? With the sort of backdrop that we saw significant supply growth in 2022, up more than 20%. We saw continued growth in 2023 of roughly 8%. And we've seen that moderate throughout 2024 of sort of starting the year and closer to 10 and ending the year sort of closer to 5%. Where does that leave us for our outlook for supply growth next year?
Yeah, that's a great question. I'm really glad that you brought up the supply growth that was so high in 2022, because this brings up the third leg of investment that we haven't talked about yet. The interest rates, that's the time value of money, sure. And then we also have housing prices, but there's also STR performance, the cash flow. That's going to be very important. So because we did have that performance in 2021, that huge outsized performance, and thus a gigantic influx of new supply in 22, that to some extent still persists, we've seen that unit level performance decline from that high. And it's looking like in 2024, it's a bit below the long run average, our occupancy. So, and we did see pretty big RevPAR declines in 2023, such that the increase that we did see in 2024 probably not going to get us back to where we were. So we've got a lot of investment headwinds. This is the best part about forecasting, my favorite aspect of forecasting, when I can forecast something that's already happened. But we're expecting supply to diminish, just the growth to diminish, I should say. It's going to slow down. It has been. So it's year on year, it's been slowing very, very quickly. We've seen new listings as well decline pretty precipitously after we started increasing rates in March. So we're expecting that trend is going to continue because we've got all these investment headwinds. So 6.9% supply growth in 2024, then 4.7 in 2025, and then a further reduction, though less extreme, in 26. It'll be 4.6%. So yeah, supply has been declining in response to these things because a lot of these trends are a year in the making at the very least. The new developments that we've got, if anything, are just going to continue some of the trends that we've already seen for a little bit longer than we anticipated, and that's going to continue putting downward pressure on supply chain.
No, that makes sense. So, and if there are some factors that might re-accelerate sort of investment, it would be among those three pillars. So either we see a reduction in interest rates further and above what we've already seen or what we expect. Maybe we get down below 6% in 2025. That could be a sort of investment catalyst. We see any sort of decreases in home values that maybe open up new investment opportunities that would maybe be separate from any changes to the overall economy. And then third, like if we start to see a real strong reacceleration in industry performance, that could, and essentially the cash flows could then cover the higher investment cost given current home values and interest rates. Is that right?
Exactly right. Yes, and there are potential things that could happen. Unexpected events regularly occur. Every time we say that things are going to be calm, and even something like a pandemic or a great recession seems to pop up in recent history. But looking at where we are at today, the trajectory that everything's going, unless something unexpected happens, that's essentially my takeaway.
All right. So just to get this recorded, you aren't predicting another global pandemic in 2025?
Knock on wood, but I'm pretty optimistic on that front. Gosh, though you never know. You never know. There's sort of bird flu and monkeypox and all kinds of interesting diseases out there, but I'm hoping that we won't see the catastrophes that we've seen in the recent past repeat in the future.
Okay. So given sort of where the industry's at today, I kind of feel like that 4 to 5% supply growth is sort of baked in right now. Now, the other factors when we maybe switch gears from investment to operator is, all right, like 4 or 5% is some of the lowest supply growth we've seen in a really long time. It maybe if not ever outside of 2020 when we saw listings decrease because of the pandemic. I suspect that may like introduce a pretty positive sort of operating environment, given that, and we don't have to absorb a whole lot of new supply, and that it might allow us to start to grow occupancy again, absent and weakening in the overall economy. And you already told me that, and you think the economy is going to be relatively strong. So, how does this supply forecast sort of play into our outlook for maybe occupancy, ADR, and RevPAR growth for 2025?
Well, it's great that you point that out. And I think that 2024, 25, 26 is going to be when operators can catch their breath. We've been seeing declining occupancy since 2021. And we saw very, very low demand increase or demand growth in 2023, right? 1.8. It was almost completely flat. Nobody took any additional vacations in 23. In 2024, though, I think we probably did see a little bit of pent-up demand contributing to the demand growth. We saw 7%, pretty big turnaround. So, that has helped our occupancy stay at least about even with last year, even with 6.9% supply growth. The supply growth is going to continue diminishing. And I think that demand also is going to cool a little bit, but not quite as much as supply. So next year, we're seeing demand nights increasing 4.9%. So a little bit below that 7% because we don't have that sort of pent up deferred demand from 23, but still a pretty good number and higher than the 4.7. So we're going to see occupancy start to creep its way back up. This is going to even further accelerate because all that stimulus that we've been talking about is going to start hitting people's wallets. So in 2026, I expect that demand to start, that demand growth to start reaccelerating, particularly in resort markets where people are going to love to take those vacations with the little bit of extra money they've got in their paycheck. And that's going to increase demand to 6.2, even as supply continues to fall to 4.6. So we'll actually see occupancy nearing its long-term average of around 56% by 2026. So you said for operators, that's great. We don't have this competition coming in like we used to, messing up our comps, messing up the predominant price that's going in the market, offering sort of tons and tons of new options. We're going to see a more measured, I think, supply growth in comparison with our demand.
Yeah. So, and that seems positive for me. So, with our expectation for the year of RevPAR growth up, what do you say? Anywhere from what 2 to 3% next year?
Yes, 2.9, in fact. So just about 3% for RevPAR. ADR, interestingly enough, did not respond well to inflation. Price of everything else went up, but we had a tough time in 2023 increasing price. With some of the occupancy stabilization that we've seen this year, we're actually starting to see some pricing power return. This is probably going to hold for the near future. We're going to start seeing ADR increases as more of a regular feature. That's going to help our RevPAR to grow at about 3% in 2025 and then 3.7% in 26 as we're seeing that additional incremental demand increase occupancy.
Okay. And then one of the sort of questions I get a lot is how does and what we're talking about nationally compared to a local level? And there's a few different ways we can go about it. One is talking about the outlook at a city level. And I know that you forecast 50 markets. And then there's also the how sort of existing performance sort of varies around the sort of national average. And so we talk about 2024 growing at 3.4%. That said, and 100 markets had falling RevPAR in 2024. So there is quite a bit of weakness still out there, depending on the market that you're in. So, and in the research that you've done leading up to this outlook report, are there any sort of patterns or themes you've seen with areas or property types that have seen underperformance or overperformance over the either past year or going forward?
Yeah, and that is also a good, a very good point because we do talk about this national stuff. And when I've been looking at the markets, a lot of very highly localized market specific stuff dominates several of these markets' performance. And we can talk too more generally about just location types. We've got that supply growing at about 4.7% in 2025, but it's clearly higher for small city and rural areas, higher in mid-sized city. It's been lower for urban. That might pick up a little bit. Coastal, we know that supply growth is sort of difficult to attain in coastal environments. So there's definitely location-based variation. And when you look at a market level, I'm looking at, say, 2025, my top RevPAR, and it's, very, very local stuff. And recovery from poor performance is one of the things, one of the main things that is causing really outsized growth next year. And this might be for, operators in the area or even potential investors. But, those Maui wildfires were devastating. But, as a result, in 2025, Maui's RevPAR should increase as we recover. And same thing with a lot of, sort of hurricane devastated areas, not necessarily for hurricanes, Milton and Helene, which are very recent, but Hurricane Ian we saw had a big deleterious effect on Cape Coral, Fort Myers, and they're coming back pretty strongly. Something else that we've seen, and you're in Destin right now, but also, there's a little bit more outsized performance in the Gulf The Gulf markets have a real kind of cycle of price increases and then kind of occupancy increases, and they kind of take their turn. We saw, for instance, really, really big price increases at the end of 2022 for a lot of coastal places, and this led to pretty flat revenues in the following year. But 2024 and 25, we've been doing pretty well in the Gulf. So say Gulf Shores, Mobile, Destin, Fort Walton Beach. Those are some areas where I'm expecting pretty significant RevPAR growth over the next year because of this additional pricing power that they're going to have. Also, one other big sort of upset, I guess, in 2023, 24 was, of course, New York and its effect on urban markets, generally speaking. So with all those regulations, and it's not just New York that has put in new regulations. There's a lot of regulations that are going around urban, but New York was very dramatic, and we saw that it had a sort of really, really big downturn, I guess, over the last year, and to the benefit of where Newark and Jersey City. So that had been the leading performer. So Jersey City, Newark, probably not going to have really big growth in the upcoming year because it's already at sort of that very, very high level as well. Also, this 2024, we had a very weak ski season in January because of the low snowpack. So Big Bear out in California is going to do, I think, a lot better this year. We're already starting to see some of that turnaround.
Awesome. Well, it seems like it's going to be dynamic year for growth. As we think about risk and worry, is for some reason, and I always go towards the negative when I talk about the outlook, especially when things are positive or at least seem positive. I want to start thinking about what could possibly go wrong. So maybe sort of last thoughts as we wrap this up is, as we think about 2025, what are your biggest worries for the year ahead, and what might derail an otherwise positive outlook for the industry?
Well, there is always geopolitical instability. That doesn't seem to have gone away. We've got a lot of unrest in Europe, as well as in the Middle East. And it's not clear exactly how the new administration plans on dealing with this. We do have maybe some increased isolationism as far as higher tariffs goes, and maybe some frosty relations with Mexico as we talk about the cartels and what the U.S. might do about that. So those are some risks. And of course, every time we have a inflationary spell, and the Fed has gone after it. I've said earlier, I mean, we made the soft landing, we did it, but we've never done it before. Well, maybe I was speaking too soon, right? Inflation can come back. We've had this sort of thing happen before, where we were able to reduce inflation, then wage spiral might happen, or some sort of longer term structural shift causes inflation to come back, and that can put a serious crimp on growth and development. We saw it in 23, and we hope we don't see it again. So, I mean, those are some extant risks out there in the economy. We've seen the labor market has been very robust. It's been very stable and steady, very strong. If we see that reverse, we could see things turn around very, very quickly as well. So, and of course, we still haven't solved this housing affordability issue. So there may be some plans to start addressing that, or maybe this will continue to be a sort of a crimp on growth as well.
Well, Bram, I hope none of that comes true, and that it's sort of smooth sailing from here. But thank you for all your time and effort in putting this report together. I'm sort of outlining and all these scenarios, thinking through our modeling efforts, and giving everyone in the industry something to at least use as a guide wire when thinking about our outlook for the year ahead.
Sure thing. Yeah, after a tumultuous few years, I feel pretty confident that the short-term rental market in the U.S. is on firm footing for the near future. Anyway, it's always a pleasure talking with you, Jamie. Always a fun time on the STR Data Lab.
Awesome. Thanks, Bram.